Hey everybody, welcome to this free edition of our weekly roundup, our Trader User Group weekly roundup for the trading week ending January 28th, 2022. I'm Preston Brenton. Thanks for tuning in. Well, the theme this week is who is exactly in control of this market? Right? Is it the Fed, inflation, interest rates? Well, let's kind of dive into this past week and see what we got going on underneath the covers here. If we take a look at this, well, let's just take a look at the index performance for the week. Everybody had a strong finish to the week, but it was not going that way leading up to Friday around as late as 11 p.m. Eastern Standard Time. Then we had a very strong, robust move higher to end the week. You can see everybody was in the green for the week. Year to date, everybody is still in the red. Correction territory for NASDAQ and the Russell. In fact, the Russell 2000 is probably near bear market territory. S&P did go into correction territory, moved up a little bit off the lows. The Dow, about 4.4% down, but it was down worse than that. You can also see the PE ratio has started to come down. The forward 12-month is now below 20. It's at 19.72. Dividend yield for the S&P is sitting at 1.4. Treasury came in at 1.78. So the 10-year Treasury is still about 38 basis points higher than the dividend yield for the S&P. However, the earnings yield for the S&P, based on an annualized earnings factor of about 205, the earnings yield as of Friday's close is about 4.63% in the S&P. Still about 2.8% higher than the 10-year Treasury. And then you can see the current VIX, still very elevated. It finished the week at 27.66, but the prior week was at 28.85. And we were stuck kind of in the 30s for most of the week. But it's still elevated. Then you can see the sector performance for the week. The best is energy. It's also leading the way annually, too, at a whopping 18.25%. And we still have another, 4 days or 3 or 4 days to go into the end of January. Worst performer for the week was industrials discretionary, bringing up the rear annualized. But like I said, these late gains help the indexes move higher for the week. Okay. I think the fears that the Feds might be a little bit behind the curve and forced to raise the short-term rates a lot more quickly to tame inflation kind of weighed on the markets. And then this past Wednesday, we had the FOMC policy statement and press conference, and our illustrious Fed Chair Jerome Power Ranger Boom Boom Powell, which is what we like to call him, he left open the possibility that they could hike the rates more than 3 times. Now, going into the markets were expecting, the Fed Fund futures expecting 4. And then coming out of his press conference, now it's kind of gone up to 5, maybe even possibility of 6. And I will remind everybody that just in Q4 of last year, they didn't think they'd hike the rates more than once or twice for the year. So that's a big switch, guys. And that has caused a little bit of a revaluation of PE ratios across all asset classes. So that's kind of why we're down a little bit in January. In fact, January, we had the worst January since 2008, at least the first start to the year. So that's kind of where we're sitting right now, okay? From an economic data perspective, this past week, we did see the economic growth in the fourth quarter. It showed GDP rising at an annualized clip of 6.9%. That was well ahead of the estimates of 5.4 to 5.5. And annually, the markets in 2021 grew 5.7%, the fastest pace since 1984. But you've got to look beneath the covers to see that annualized rate for Q4 GDP, the first pass we got this past week, at 6.9%. A lot of that is inventory build, with a lot of companies ordering inventory in advance with a fear of a slowing supply chain or bottleneck supply chain. So I think that attributed a lot to that bump in the GDP of 6.9 in Q4. Okay, I think it's going to come down pretty hard in Q1 and Q2 of next year. Now, we did see the composite gauge of both service and manufacturing come down a whopping almost down to 50.8. That's barely expansion territory. It's the lowest level we've seen in 18 months, guys. So we are seeing a slowing down of the U.S. economy dramatically. The University of Michigan Consumer Sentiment Gauge was also revised lower to 67.2. It's the lowest it's been since November of 2011. So we got a lot of worry on falling real wages, which means even though wage hikes are plenty, everywhere you go, you're making more money, but inflation has taken away that extra income and actually driving wages down. So you got Americans worried about that as well as inflation. So we've got a lot of issues rearing itself there. Now, of course, if we look over across in Europe and we look at the European data, you can see that everybody was in the red pretty much for the week. You can see year to date is everybody's in the red except for the FTSE and the Hang Seng, which is the Hong Kong index. Really not a good week. Over in Europe, in fact, shares fell 4 weeks in a row is where we're sitting right now. Their PMI, their composite PMI, came in at 52.4. It's 11-month low, so we're seeing some slowing down there as well. I think there's a lot of escalating geopolitical tensions, primarily around Russia and the Ukraine, and just, how do we get out of that without creating a war? So there's a lot of geopolitical risk sitting there. So that's weighing on a lot of the asset classes all across Europe. Okay. And then, of course, if we go down to the Asian markets and look at Japan, they had a negative return for the week as well. Although we did hear their Bank of Japan governor, Kuroda, he's continuing to reiterate their commitment to ultra loose monetary policy. Okay. So that's helping them out just a little bit. We did see their services sector fall a pretty good bit while manufacturing kind of showed strong improvement. And the IMF revised their upward guidance for Japan's GDP next year in 2023 by 40 basis points. So we'll see how that works its way through. And then finally, over in China, they're starting their week-long Lunar New Year holiday. But they're continuing to see problems with their debt crisis in the real estate sector there. So we'll see how that plays itself out. But that's what's going on across most of the markets right now as far as how the week performed. Excuse me. What I'm going to do is I'm going to shift you over to a weekly chart of the S&P 500 E-mini futures. So let's just get you over there real quick. And what I'm going to do here, I'll wait for it to come up on the screen, of course. Excuse me. Okay, if we look at the markets right now, you can see that the that candle on the screen there, that big green, looks like a hammer. Well, it is a hammer, which generally precedes a large move higher. All right, now this is a weekly time frame. All right, hang on 1 minute, guys. I'm going to put you on mute for just 1 second. Let me figure this thing out here. Hang on a second. I'm going to mute you for a couple of seconds. All right, sorry, I'm right back with you guys. That'll teach me to eat a bran muffin right before I do this, get stuck in your throat. So anyway, you can see this hammer. That typically means that we can expect a little bit of price action to the upside. You can see we came down and made 2022 lows. We were actually down 12.4%. So beyond correction or in correction territory for the S&P E-mini futures. You can see the closing price of last year near our all-time highs for the markets, and then we've just spent, as I said, it's the worst January since 2008 for the markets. Now let's just go back and let's zoom in a little bit and put it on a daily chart here for a second. You can see here that this past week it was very volatile. You can see the hair on the candle or the tail on the candle, a lot of indecision on Thursday, and then Friday. Even the Friday candle looks kind of like an elongated hammer, right? I mean, just really really strong selling or buying coming in towards the end of the day here. And was just a huge reversal in the markets. Now, we also regained the 200 EMA. That yellow line is the 200 EMA. That was an all important number. And on this daily chart, keep in mind that most bull traps are exactly what they mean. They trap you into thinking the markets are bullish and then it rolls over. Typically, you've got this Elliott wave count of 1, 2, 3. These are the primary waves. And then there'll be a 4 count up here and then a 5 count somewhere down here like that. And on this 4 count, you typically kind of move up like this. And then you got that bull trap where it thinks it's bullish and then it just comes down like this, and then it finishes down somewhere down in this area down here. So this is what we have to be careful for. We have to watch the height of this Elliott wave 4. Now, these Elliott waves have been known to shift and change, which is why I don't use them to trigger a trade, but I do use them as kind of to help support or refute a general bias that I'm looking at. Right now on the daily chart, the odds favor a bull trap. Okay, that's what they're showing right now, meaning we run up here at a little bit over 4,500, maybe even just south of the 50 EMA. So what I'm going to do on the daily chart for our members is, if you look at the 50 EMA, it's sitting at 45.83. Now that seems like a 150 point move or so off of a big move that we had on Friday, and we can get up there and then roll back over. You can see the prior pivot lows sitting right in this kind of area right here, and that low, closing low, was sitting around 4,500, a little over 4,500. So I was telling our members early in the day on Friday when we were sitting down around 4,300, I said, I want to see us get over 4,400 and get into that going into the weekend. I actually said that on Thursday, and sure enough, Friday morning, it didn't look like we were going to make that. And then all of a sudden, by 11 or 12, we just had buyers come in. Some of that buy-in is month-end adjustments, reallocations. We're seeing corporate buybacks, things like that, to finish out the month of January. And there's some buy the dip crowd, obviously. But what we've got to do is, and we hit that 4,400. So I want to see that we hold that 4,400 going through this next week. If we move up to the 50 EMA, which is around 45.83, I want to see us grab it and hold it. Okay. The 200 EMA is running flat. The 50 EMA is moving down. Typically in bear markets, you'll broach the 50 and then 200, and then you'll come up and either retest the 200 or the 50, and that is the excellent point to sell, add to your shorts, and it rolls back over. So we're going to get a good idea on, is this the all-time high for the S&P for this year, or are we going to make new all-time highs? All right. And remember, this all-time high was made on January 4th. So really just the second day of the trading year. And you can see just prior to that, we ran sideways for one solid week, and then it gave it all up as if by magic on the 5th. And then we just started rolling over. As money is starting to accommodate and adjust, evaluation models are starting to adjust and accommodate more rate hikes coming, and driven primarily by higher interest rates. So this is what we're going to watch on the S&P 500 E-mini futures. And then, of course, if we look at NASDAQ, it had a lot of damage to it. You can see on NASDAQ, we actually hit a low of 18.25%. This is NQ, the NASDAQ futures. 18.25, folks, almost a bear market, right? And then we turned up, we went sideways. It held up fairly good, roughly 13,700, but that was the exact number, 18.25% down. And then you can see we're well below the 200 and the 50. So unlike the 50 on the S&P, I want to see us hit and regain the 200 here. Now the 200 here started to roll over in a downward vector. Obviously the 50 EMA has got a downward vector too. So I want to see us clear all of this, or the odds still favor a bull trap where we come up into this zone and then roll back over. So that's what we got to watch. Don't let a 1 or a 2 or even a 3 or 4 hard day move up, dissuade you until we can see it move up over key resistance points and then do a retest, hold, and then move back higher on higher volume. That is what we've got to see, okay? And speaking of volume, if I put the volume here, you can see this volume in this sell-off. You can see that I've got a 5 EMA and a 20 EMA. So when the purple line crosses the blue, volume is higher than a monthly average because I'm using the 5-day over the 20-day for moving average. And then you can just see, as we found the bottom, almost like a blow-off bottom, huge volume here. And then the volume starts to come down. And then you can see this volume was under the 20-day average on this high move up. So again, we get into these end of month shenanigans. Once we get into early February, we'll have a better clue as to where volume wants to go. And then, you know, price typically follows that. So let's see how this thing plays itself out. Okay. Now, if we look at the Fang Index, I've got a customized index in eSignal. You can see the Fang market is down 24.4 or 1%, and that was this week. It was on the 24th. So we were in bear market territory for the top mega caps. My Fang Index is comprised of Microsoft, Facebook, Apple, Netflix, Google, and Amazon. And then we've had strong earnings by Apple and Microsoft, so we've seen a little bit of a move up off the lows. Netflix was the only one that really cratered during the earnings. And then you can see it's moving up. But like NASDAQ futures, I want to see us regain our 200 EMA. So folks, we got to watch this very closely. Don't let a couple of strong days negate the fact that we've had a lot of damage done in the markets. And you can see just how far down we are. And let me show you the Russell. The Russell is even uglier. Now, I haven't even adjusted this one. We were already down 21.7. And if I move it down a little bit more, that would put us down around the 22, 23% official bear market territory. Now, where we closed here, we're like close to being right in bear market territory. And you can see here when I show you the 50 EMA not only is going down in a downward vector along with the 200 EMA, but the 50 EMA has crossed the 200 EMA. Folks, that's not good. I'm hearing not a lot, but I'm hearing some gurus, some talking heads on TV. Most of them are gurus in their own mind, by the way. But I'm hearing a lot of the talking heads on TV saying that we're officially in a bear market. The prices just haven't pulled down 20% to show that yet, meaning the all-time highs have already been made for this year. I'm not there yet. I need to see a couple of attempts at moving higher. And then if we roll over and make new lows, then I would probably be in agreement with that statement. So that's what I'm watching for right now. Now, I will show you with this big move, let me show you the cyclicals versus the SPY, right? Look at that chart. If you look at this, you would say, wow, that's a bullish chart. Well, what this shows is it's a combination of energy, financials, materials, and industrials weighed against the S&P. So as of like magic at the beginning of the year, those guys started outperforming the S&P. Now they all went down. Most of them went down except for energy, but they outperformed. They're typically known as cyclicals, meaning they're very cyclic in nature due to shifts in the economy. And on Friday, money came back into growth over cyclical or value stocks, but I do believe this year cyclicals are going to do fairly well. That would be energy. As I showed you earlier, they're already leading year to date, and they had a very strong week. They also led last year as well. So we're going to see kind of a demand pull in energy primarily. So I do like that one. But I also like materials, financials, and industrials. Commodities typically do very well in a rising interest rate, higher inflationary environment. So we got to watch this because I just wanted to show you that one. And then if we come down, and let me just get this off the screen here real quick and show you volatility. You can see on the VIX, we just had a capitulation in the last part of the day. Let me just to show you, let me put it on a 15-minute chart and show you. You can see here on Friday, we were actually higher in the VIX, and then it's sitting at 31 at 10 o'clock. And then we were as high as 30, almost 31 at 2:30 in the afternoon. And then it just gave it all up. That was when all the buying came in and moved the markets a tremendous amount in the last hour and a half of the trading day, right? Now, if we come back and put it on the daily again, just looking at volatility, um, you can see here we kind of peaked out right around what we did here. We did have an intraday high on the 24th, sitting right around 38.94. That was a quick print, and then we just kind of backed off of it, right? And notice we were in this markets in a correction territory zone for the VIX, and now we're still in a down fast market. Just because it says down and fast doesn't mean it always goes down. It can also go up, but the key term is fast. The markets are moving really quick, hence you got higher volatility. Okay, I think eventually vol is going to work its way back down. I think we're going to have a little bit of a follow through from Friday, early next week, and then we'll probably get that bull trap test in the middle of the week. That's kind of what I'm looking at. Now, that could all change with any economic data that hits, or we get some change in the geopolitical issues with Russia and Ukraine, and just how we and the NATO countries respond to it. But we're going to watch that very closely. Okay. And of course, if we come down and look at bonds, we've seen interest rates move down just a little bit. Bonds have moved up off the COVID lows and the 2022 lows. Any rise in bonds, I'm all in favor of selling bonds or shorting bonds, right? And I've talked to our members a good way to play rising interest rates for this year. But that's a trade that I like, and it's keep in mind it's going to be one that's going to be there all year long. So you don't have to feel like you have to chase it. Wait for bonds to move higher. When it starts to roll over, you can jump into it. Okay. So that's one that looks good. And then if we look at the 10-year rates, as you guys know, I've had this target on my chart for at least 6 months now. And my target was around 1.9, but it went up as high as about 193 down to about the 184. And we came right up and hit it, gave us an Elliott wave 5, which typically means you have kind of like an ABC sideways, maybe slightly down pattern. But I think we're going to bust a move through this and get over 2% next year. But a lot of it's going to depend too on some existential data, primarily from inflation and just the speed with which the Feds and boom Powell is going to be forced to raise the rates. Okay. If we come down and look at currencies, well, the dollar has moved a lot, right? I mean, I got to adjust the chart right here, but you can see it's moving up to my target, which I've had on the screen for a while. We had this breakout right here. Let me just put it on the screen. That breakout right there. And now you can see that candle, which is an indecision. My target for the dollar was right around here, about 97.95. Remember, the dollar, it moves based on the movement of other currencies, right? The dollar is not an independent currency. It's called the dollar index, and it moves based on the euro and the yen, the pound, the Canadian dollar, Swedish krona, and the Swiss franc. Those are the primary currencies that control where the dollar index goes. The euro being the biggest, it's almost 58% of the dollar index. So I believe it's going to run up a little bit higher. It's a crowded trade. Everybody's long the dollar, but I think people are going to start to get out of it, and I think the dollar is going to come back down and test the 50 EMA again. So you've heard me say being long the euro. I do like the euro long. If we go take a look at the euro futures market, you can see here where, we've made, let me just adjust this. We're coming down and hitting my target down here as well. My target with Euro futures was down around 110 to the dollar, 111, 110. I think we're going to hit this. We got this divergence setting up. Should it start to consolidate and move up, at a minimum, it's going to come up and test this 50 EMA in the 2021 close. And then I think we're going to see where it wants to go. But I do believe it's going to go higher. So longer term, I do like the euro over the dollar. Okay. And then, of course, if we come down and look at precious metals, if we look at gold, near term, I'm not that enthusiastic on gold. Longer term, I will be. You can see that gold has a hard time getting escape velocity north of here. I had said that unless we clear this area up here, gold can be a swing trade or a very short-term trade. And you can see here we just made a new 22 low. All right, we were in the green at the beginning of this week, and then it just rolled over. And that's kind of where we're sitting right now. And speaking of another asset that is viewed as a risk-off asset or an inflation hedge, and as you can see right here, clearly gold is not it. And if we come over here and we look at Bitcoin, which is another one that people have just been decimated on. You can see at the lows here it was down 52.63% from the all-time highs. Okay, you can see we're in the red for the year because there's the 2021 close. Early in the year we made a 2022 high, but well off the all-time highs. I think Bitcoin could run a little bit lower. Notice it's on an Elliott wave 3, which suggests we're going to run up, get a bull trap, sucker some people in, and then we're going to roll back over, maybe go into the high 20s or mid 20s. At that point, I think picking up Bitcoin would make some sense from a trade perspective. Okay, so that's a little bit about what I like about that. Now, if we come down here and we look at getting back into the metals again, if we look at copper, longer term, I like copper. Short term, they're going to go where China goes. And as you can see, this chart kind of looks like the Russell in 2021. It's on a bridge to nowhere, up and down, up and down. It's a great little swing trade. Get down here, you want to buy it. You get up here, you want to sell it. But if you're trying to trade it longer term, forget about it. I wouldn't trade it right now. It's just not ready to go anywhere. And then, of course, if we look at oil, well, I think oil is doing pretty much what I have been saying for a while now. It's going to, and let me just readjust again. I believe it's not going to get much higher than $95 a barrel, low 90s basically. We are on an Elliott wave 3, which suggests a little bit of a pullback and then a final thrust higher. I know a lot of the investment banks, especially Goldman, they always tend to hype gold or oil, calling for it over 100, 110 a barrel this year. We'll see where it goes. I don't think it's in OPEC's interest or OPEC plus Russia's interest to drive oil too expensive because that pushes people out of oil quicker and into EVs and other alternative forms. But right now, I think the momentum is probably going to carry us higher with a little bit of a profit-taking pullback on oil. And nat gas, we're having a lot of cold snowstorms here in the US. So you can see nat gas. This is what happens. And at this price right here for nat gas, I'm very interested in maybe picking up a put and seeing where this thing goes. Every time we get up here, I like shorting nat gas. All right. And the easiest way to do it is with a defined risk trade. That would be with an option on natural gas futures. You can see it ran all the way up here to about 7.3. It closed here. Hopefully it'll stay elevated into Monday with a strong demand on that gas. Now, keep in mind, the risk in this trade is if Russia does go into the Ukraine and they start to peel back and reduce the amount of natural gas they're sending over to Europe, even though this is U.S. nat gas futures, it's going to put demand on nat gas internationally, and you're going to see nat gas probably just go. It's going to go to the moon. It'll be back up over here, and it'll definitely be worth a short if you don't short it here. So that's a trade that I do like. I do like taking the contra in nat gas just because it's so volatile, right? This is nat gas shouldn't even be down at this level here. It should be below 3. But you can see market forces, and in fact, you can see here the very next day, if I zoom in, nat gas came back. It came down hard the next day, but even here it's still elevated, right? So I do like it coming back down just a little bit. That's a trade that I like playing. All right, everybody, that's kind of where we're sitting right now. Members, I will see you in our chat room for our week or in our session for our weekly market watch coming up. If you're not a member, I highly encourage you to come in. We're having a lot of fun this year. It's going to be a wild one. Everybody, have a great weekend. Enjoy the professional football playoffs. Take care, folks. Ciao now.